Hi, I'm Tony Edward. I'm the author of the book Rethinking Crypto and the host of the Thinking Crypto podcast. And you are watching Taking Stock.
Two minutes to go into the only closing bell down here on the one and only trading floor of the New York Stock Exchange. We got head coach Marcus Freeman of the Notre Dame Fighting Irish on deck. He is set to ring the closing bell. He and a bunch of his players on the podium behind me. But before we get to that, we got the great Peter Tuchman, the Einstein of Wall Street. Kind of a weird day, a market trying in search of an identity. What did you see on the tape today?
Exactly what you just said. The market is trying, look, we have these days in between earnings where the market's trying to find direction, right? Unfortunately, the last couple of days, we're seeing more of a little bit of a weakness than strength. But one day does not make a market, so I'm unclear. And I don't like to project things if I don't really have a decision. So basically, yes, we're going to quite close right off the lows of the day. Solid volume, the buyers are being patient, and the sellers are very, I would say, sector centric.
Oh, yeah.
Right? It's not any broad. There's no broad-based selling. Right? They'll pick a side like with Google today, and they'll get into it. What we're seeing is though, there's the old buy and hold model is not what's happening here. When they want out of a stock, they get out. And that's why you'll see sort of these days where it'll pick a trend. It's a classic trend day.
Yeah, and they might become more liquid and buy into something else a lot of times. Like
100%. They're not just dumping, they're getting into some value.
Come back and see us again tomorrow. Peter Tuchman, the Notre Dame Fighting Irish, ringing the iconic closing bell right now. Head coach Marcus Freeman of the Notre Dame Fighting Irish ringing the closing bell here at the New York Stock Exchange a few moments ago. Your final tail of the tape, the S&P down 0.5%, the Dow down 0.2%, the New York Stock Exchange Composite Index in the green 0.3, the small caps down fractionally 0.06% into the close. We did see a fair bit of selling and a sell-off overall in chip stocks. Alphabet around 2 o'clock this afternoon announcing its most powerful AI model, Gemini 3.5 Pro, is delayed. That weighed on Alphabet shares into the close, and we saw the rest of the S&P 500 for the most part follow suit as well. Let's bring in Eric Criscolo, market strategist right here at the New York Stock Exchange. So you actually told me about the Alphabet news. I had not really seen it or paid attention to it. What did you see around the 2 o'clock hour? And we could kind of see, given how consolidated, how important a name like Alphabet is, put some downward pressure on some of the other Mag 7 stocks. And then we saw the S&P. We're not going to close at session lows, but not very far off.
Yeah, so the weakness today absolutely concentrated in tech. Basically the semis though, the memory names, the names that have absolutely been on an incredible run the past 3 months, 6 months. Names like SanDisk, which 10x this year, they're pulling back. And it's really concentrated in those tech names, in those memory names, in those semiconductor names. The hyperscalers were actually doing well recently, even Google, even Alphabet. They did have that news at 2 o'clock, that took Alphabet down, but the other hyperscalers were holding in there. They were doing well. So it's the weakness is very concentrated right now. The S&P 500 declined, but the equal weight was up about 0.5%, so about a 1% difference between the equal weight and the S&P 500. So a lot of the stocks are actually doing quite well.
And a lot of outperformance here. Let's take a look. Consumer staples, healthcare, real estate, energy. So it's not tech doing the heavy lifting, but at least we are seeing market rotation where investors are saying, hey, we usually like these names. At least for today, we don't like them as much, but we find other names that we like a little bit more, at least in the short term.
Yeah, we've been talking about rotations this entire year. It's been a staple of the market complexion. Flows just coming into a sector, coming into a group, rapidly coming out of it. The flows are fast and they're big. A lot of it was going into tech earlier, now it's coming out. It's not surprising, like I just said, some of those names are up an insane amount over 1 year. So seeing that money come out, investors booking their gains and looking for the laggards, the underperformers to move into, that's kind of the name of the game right now.
I wonder what your take, first time really you and I are talking at length, cooler than expected CPI, cooler than expected wholesale inflation print. What does the Fed do with that? As of today, we're less than 2 weeks from the July meeting.
Yeah, so you've seen the rates on the shorter tenor kind of pull in a little bit, especially the 2-year. So that's kind of telling you that the market is kind of pricing out those rate hikes that they were pricing in earlier. However, we still don't know what those task forces that Warsh has talked about, they're going to come back with their recommendations across the Fed operations, communications, the data they look at, how they implement monetary policy. All of those task force recommendations are going to come out over the next several months. Then maybe we'll start to see we'll get a better gauge of what the Fed or what Warsh wants to do with the Fed as far as monetary policy. Right now, though, it sounds like we might be in a little bit of a holding pattern for a little bit.
Yeah, I want you to take on earnings. Obviously, we're through the big banks. Got a few other regional names set to report into next week. How about a few of these other names? GM, 3M, AT&T. We got a few Mag 7 names, Tesla and Alphabet. A bunch of the airlines kicking off. I mean, here we go. This is the lifeblood of the corporate markets. Is earnings season. What else is on your radar? And we know investors are paying attention to a lot of these big consolidated names.
Yeah, the financials. They were the leadoff hitters. They were always the leadoff hitters, and they got on base. They started well. They said the economy's doing well. They don't see any signs of credit stress. The consumer is resilient at least. The economy is healthy. So they kind of led off. They hit a single, set up everything else. Now we get into the meat of the order. Tech, like you said, it's going to be really interesting to hear what Alphabet has to say after they have their model delayed. Yeah. IBM is going to report their results. They had a weak pre-announcement earlier. Stock got hammered. Everyone's going to want to hear what they say in more detail. And then, those other names, right? Everything else that has been doing well, right? How do they respond? What are they seeing? What is 3M seeing? It's a huge conglomerate across the globe, right? How are they seeing the industrial economy play out? Yeah. So that's going to help kind of set the tone for that laggard trade or that everything else trade that's been happening.
Eric Criscolo, market strategist here at the big board. My man, come back anytime.
Anytime.
Nice to see you here. A few of the top analyst calls you may have missed this morning that move the tape here on Wall Street. First up, JP Morgan upgrading BlackRock to overweight following earnings yesterday. Analysts say the stock will catch up to the solid fundamental outlook. Price target $13.64. Next up, BTIG downgrading Etsy to neutral from buy, really on valuation concerns. They say shares have pushed well past their previous price target. Shares of Etsy up 50% year to date. Finally, Piper Sandler initiating coverage on SpaceX with a neutral rating. They cited some, and I quote, idiosyncratic near-term headwinds. By the way, that's a great name for a band. We got the 13th Starship test flight scheduled for later on today, right around 6:45 p.m. Eastern. Todd, let's take a look at shares of Abbott Laboratory, the top dog in the S&P 500 today, up 10.7%. Its best daily percentage gain going all the way back to 2002. Reported a beat this morning before the market opened. Strong sales reported for the quarter for its medical devices business. That, of course, includes the very popular Freestyle Libre glucose monitor. Shares are down year to date, however, about 20%. Scarlett Sieber from Money 2020 sat down with CEO Cameron Fowler of Early Warning to discuss the future of payments, how Early Warning is integrating artificial intelligence, and a whole lot more. Take a look.
Welcome back to Taking Stock. I am Scarlett Sieber, Money 2020's Chief Strategy Officer, and we have a guest for you today. I am so excited that we're going to have Cameron Fowler, the CEO of Early Warning, who hot off the press is going to be joining us in Las Vegas for Money 2020 USA in October. So with that, Cameron, welcome to the show.
Thank you, Scarlett. Good to be here.
So happy to have you. You know, one of the things that's so surprising or exciting, I guess, to me, Cameron, is that Zelle has just, Early Warning is well known, but for those who don't, Zelle pays other amazing brands like that. Zelle has just surpassed 1 trillion with the T, processing dollars across the U.S. annually. That's a big number. On the train here this morning, I use Zelle to pay my nanny. I use Zelle to pay my landscaper, and I use Zelle to pay back my mother-in-law. So I can get how you got to that trillion number. I think I personally contribute to that trillion number. I'm curious, you've had such a great career in financial services, for a number of decades across BMO and Barclays, et cetera. For your perspective, Cameron, where do you see the shift in payments, and what should financial institutions be thinking about right now as it relates to payments?
Yeah, well, I'll start by saying I'll tell you what hasn't changed. What hasn't changed is trust and the importance of trust. So to be a scale player, an innovation leader in this industry, if you are not worried about trust every day and everything that you do, you will struggle. So that I think is what's not changed. But in a changing industry, I think the thing that's changed the most is consumer expectation. Easy, fast, safe. And it has been our experience. You probably experienced on the train this morning. You expected it to be easy, fast, and safe for you to move those money between people that you know, trust, and love. The difference is it's not an expectation some of the time, it's all the time in everything that you do. And that, I think, is the pressure, the thing that drives the constant innovation. And that's the experience we're having now as we have only 9 years ago begun Zelle. As you said, it's now $1 trillion business. Now our consumers, our customers, 150 million of them are expecting that we can take that same experience international, because your friends and family aren't just the ones you can reach when you're on the train in the morning to your family. They could be in international corridors anywhere in the world. So that heightened expectation, I think, is the main change.
That makes a lot of sense. And I'm an ex-banker, like you. I'm a recovering banker, I would say. And one of the things, I spend a lot of time with the industry. I talk to the regulators, the bankers, the fintechs. One of the big things, everyone's talking about AI. It's 2026. We can't not. But fraud is a really central piece of that. And early warning has really been at the forefront of really helping protect the financial system for the last 3 decades as it relates to fraud and scam. From your perspective, how are you and early warning utilizing AI to, continue that and the role that fraud plays in the future of financial services?
Important topic. The AI is making the bad guys smarter, more convincing, even faster. Our job as relates to fraud and scam began 35 years ago, as you say, protecting the industry, using data to drive better decisions. Our main job is to help financial institutions, 2,500 of them, say yes to open more bank accounts, bring more people into the banking system, to say yes to the good guys, no to the bad guys. The AI capabilities that exist now do, yes, make the bad guys stronger and faster, but they enable us to innovate faster and faster and faster, which is exactly what we're doing. So the tools are different, the mission's the same, and it's an exciting time for us indeed.
I love that. Let's go over a little bit to your other baby, which is Pays. So digital commerce is another hot topic that we have at Money 2020 and across the industry. I'm curious, the role that you believe that Pays is going to help shape the future of digital commerce, specifically with that online checkout experience. What does that look like for you?
Well, we believe that online checkout should be as simple as tapping your phone in a store. As simple as that. Plus, the added confidence that your personal information is secure and has not been shared. Okay, so that's the most important thing. Similar to Zelle, which is built on consumers' trust in their bank, really, that's what's driving the growth. The Pays concept is, simplicity, convenience. What do consumers want? They want that convenience, they want security. Merchants want less friction and more confidence in the transaction. So we have 200 million cards now that are deployed into wallets for consumers across America in just a year. So we're off to a good start. We have a tremendous campaign on right now. You should use your train time to do that. Spend 10, get 10 at various merchants who are using it. And we're having lots of fun with it, learning lots, growing quickly. But the fundamental point is, the consumers deserve a secure and trusted experience, resident in their bank trust, and merchants need that as well.
Cameron Fowler, CEO of Early Warning, thank you so much for joining us today. We cannot wait to have you in Las Vegas.
Thank you, Scarlett. I look forward to seeing you there.
All right, thank you, and back over to you.
Welcome back to the show. Joining me now down here on the trading floor of the New York Stock Exchange is Vic Chavla. He is the CEO and co-founder at Symphony, a fintech savings app that goes about things in kind of a unique way. Really grateful for your time. Thanks for joining us.
Yeah, appreciate you having me. Excited to be here.
So there's a lot of apps out there. You know the space way better than I do. They gamify spending, kind of encourage risk for the user. I know you guys are trying to do something a little bit different. Give us a bit of an introduction to how it works for anyone otherwise a bit unfamiliar, Vic.
Yeah, definitely. So we're a savings app, one of the first savings app, which give you points and miles on your savings. So think about credit card points basically, but you get it just by saving money instead of spending money. So we give a 5% APY to the user, and you can get all these points, whether it's in cash or points or a mix of both, and you can transfer them to some of the biggest airlines and hotels around the entire world, similar to a credit card, but just by saving money.
And in terms of saving, it's comparable to like a saving account or something I have. In other words, instead of spending it and getting those Amex points, I just kind of need to keep the money where it is and you reward that type
think of it like a high yield savings account, but we give you points instead of cash.
How would you say this incentivizes smarter habits?
Yeah, so in a big way, like we've noticed that inside traditional finance and just the whole consumer financial world right now, you're getting aggressively pushed like prediction markets, gambling, and it's growing like crazy. Like over the last 3 years, sports betting's increased by 300%. And we want to find another exciting way for people to like feel incentivized to do healthier financial behaviors. And that's where we want to make savings more exciting, gamify with points and miles, and things like that, basically.
Yeah, it sounds like you're trying to gamify the right parts of the equation. You mentioned travel points. Why is that a priority, and any other sort of reward structure in terms of real-time feedback from your users that at least you're considering to offer them?
No, so I mean, right now, especially with points, you get some of the craziest redemption rates. For example, you can fly to Japan from New York with 100,000 points, right, first class. That will usually cost you $10,000+, but it's only 1,000 points, or 100,000 points, which is not, but that takes like 15K of deposit inside Sim to earn that many points in the long run. So we're also thinking about like Starbucks, Netflix, Uber, things like that in the long run, and especially real life experiences. I think that's gonna be really exciting for the younger generation, like things you can't buy, right? Like backstage tickets to concerts and things like that. But at the get-go, the craziest redemption offers are with hotels and airlines.
You said 100,000 points first class to Japan?
Yeah.
Booking my flight right after the show today. You got a lot of early adopters. Talk to me a bit more about user feedback. What are a lot of those points of consideration they are coming back to you with? And how's the process looking for you at the team to take what they're giving you and still try and stay active to implement them as you go along?
Yeah, so a big user feedback we've noticed so far is that, I guess a big interesting proof point is that a lot of our users are actually women, which is really rare for a financial app. About 40% of our users, day one, have been women who want to use this primarily. We noticed that, especially later on in life, apparently women book most of the travel for the families, and they love points. Points and miles is like their big thing. So that's been exciting to see. Along with that, we're about almost 1,500 users now in just a month, almost $1 million in deposits in just a month as well. And the growth rate's been exciting, right? About 3 weeks ago, we were 1/3 that level. So it's been just growing like crazy, organically mainly.
Dude, congratulations on the organic growth and growth otherwise. Really grateful to have you. Thanks for being here.
Thanks for having us.
Vic Chava, CEO and co-founder over at Symphony. Don't go anywhere on this Thursday edition of Taking Stock. A whole lot more show coming up live from the trading floor of the New York Stock Exchange right after this. Welcome back to the show. Joining us now, live down here on the trading floor of the New York Stock Exchange. Say hello to Alex Jorgensen. He is partner and head of investor relations at Prosec Partners, a comms and marketing firm that largely specializes in the financial industry. I got that right?
You did, yeah, that's right, JD.
Yeah, so talk to me first and foremost. Give our viewers an introduction to your work at Prosec, your key priorities for anyone unfamiliar.
Sure, so at Prosec we say that we help companies go public and we help companies stay public. And we work a lot, as you said, JD, with the financial services space. We also work across aerospace and defense, healthcare services, digital assets, fintech, and a whole bunch of others, including AI. And so our work lately has been really widespread. We've been helping companies navigate a really dynamic macro environment and helping them think about how to reach the most investors to achieve fair valuation.
Those are a lot of dynamic sectors to focus on.
Yeah.
How have investor relations changed even over the course of just the last few years? Because a lot of those cool techs and things you just talked about, they've rapidly evolved even in just the last few years.
Absolutely. I think the way IR has evolved is really how the investor base has evolved, right? So maybe 10, 15 years ago, most companies were really thinking about the institutional channel and almost solely thinking about the institutional channel. Today, the investor bases have been democratized. You're seeing retail investors, you're seeing companies focus on RIAs, multifamily offices. All of these investors require consistency. They want to see the same narrative, the same strategy that companies talk about in their earnings calls, but they might look at it from different altitudes. So we help companies think about that. How do you reach a retail investor and how does that look different than maybe reaching an institutional audience?
How has the investor base itself gone global? And what are a lot of those big sort of points of desire that they're coming to with? What are the things that they really want out of the process?
Investors really want three things. They want clarity, they want consistency, and they want accessibility. And so companies share their strategy. They need to do so in a clear way. They need to know what they're going after. They need to do so consistently. If companies are just sharing that clear strategy on an earnings call, they're missing opportunity. They need to be out in the market, talking to investors, talking in different geographies. And then I think this is really key, it's accessibility, right? Investors, if they can't understand that clear strategy, or if everyone in the company is talking about the same thing, but it's not accessible to these various investor audiences, then they're not going to understand why they should buy and why they should buy now.
What do the best IR programs have in common? Those common threads that make them separate from the rest of the bunch?
That's a great question. You know, we were here at the exchange yesterday, we had an event and I interviewed a key sell-side analyst who talked about just that. What he said is that the best IR programs, the best management teams do not avoid challenges. They don't shy away from the headwinds in the market. Instead, they talk about how they're taking them on, how they're going to overcome headwinds, how they're going to overcome challenges. And so it's not about always being the most optimistic. It's not about always painting the rosiest picture. It's really talking about the reality of the market today and how you're going to achieve the best results for your customers, your stakeholders, and ultimately your shareholders.
Alex Jorgensen, partner, head of investor relations at Prosec Partners. My man, you crushed it. Come back onto the show anytime.
Thanks, JD. Appreciate it.
Don't go anywhere. A whole lot more taking stock coming up live from the trading floor right after this. Welcome back to the show. In part 2 of this episode of NYC Innovates, Cheddar's very own Chris Castellino continues his ongoing exploration of New York's first robot store. Take a look.
One company in the store has been running humanoid robots in real-world environments for over a year, including hotels in New York and Las Vegas and at San Jose International Airport. Intbot is an early startup out of Silicon Valley, and its founder, Lei Yang, shares his philosophy that sets them apart.
We actually make socially aware robots. Our company name, Intbot, stands for Interactive, Intuitive, and Intelligent Robot. Basically, we build a social intelligence layer for every humanoid robot. We make these robots understand, perceive, respond naturally with human, and also with a very unique and humorous personality.
Terminal B baggage claim. Just follow the signs, and you'll find it.
Thank you very much. Have a great day. It's not just to answer questions about where to go, luggage, my terminal, but also kind of keep the travelers entertained.
Intbot's robot even has an official title, Chief Vibe Officer, and that robot lived up to the name.
Your top 5 favorite rappers of all time.
All right, off the top, gotta give it up for Kendrick Lamar, absolute legend. Then there's J. Cole, always bringing that fire. Gotta put Kanye in there. His old stuff is top tier. Number 4, Drake. He's got the hits. And last spot, gotta throw in Lil Wayne because no one punches out bars like him.
I also asked about the World Cup.
The World Cup always brings the heat. You got usual suspects like Brazil, Argentina, France, always dangerous. But hey, maybe this year we get a wild underdog story. I'm not making any predictions, but I'm here for the drama.
I also addressed the geopolitical reality in this room. Most of the robot bodies here are made in China. Intbot is an American software company running on Chinese hardware.
As a US-based company, we've actually built every piece of our software, the data, within the US, and we host everything on US-based cloud. We follow the strict privacy, data security laws, and only use these Chinese robots as hardware vendors.
The technology is moving incredibly quickly, and I'm a parent, I'm a teacher, I'm part of the Stanford Hospital, and I really care about this technology being intelligible to most people. I want people like my kids and students and patients to be able to look inside the brains of these machines and kind of understand what's happening, just as the basis for trusting them. As the robots interact with people, we expect them to be polite and understand gestures and be safe. And those are the things we're emphasizing first.
Moments like this pop-up store allow people to interact with me directly, which helps demystify the technology and builds trust. It is much easier to imagine robots as useful daily teammates once you've had a chance to meet one in person.
As you can tell from Pam's hands, she only has rigid plastic hands now because for liability and safety reasons, we don't want her to be able to hold a knife. That would be the wrong thing. And it's going to take a long time before we're fully comfortable enabling robots like this to touch you or manipulate tools in your home. We'd be scared of doing that.
Tomorrow morning here on Wall Street, we'll get the latest quarterly results from Fifth Third Bancorp and Travelers Insurance. At 10 a.m., the University of Michigan preliminary consumer sentiment figures. Thanks for watching today's edition of Taking Stock. Have a great Thursday night. We'll see you again tomorrow.